Well, in a blow to the Chinese economy, MSCI, a global equity index provider, said it will not include China's A-listed shares in its emerging markets index. And for more analysis on what this means for investors, I'm joined now by Mark Lashini, the chief investment strategist at Janney Montgomery Scott. And Mark, help us make sense of MSCI's decision. Stocks in China are slightly to the downside. What do you think were the reasons behind this?
Well, I think it has a lot to do with still the immaturity of the Chinese equity market. I mean, the domiciled companies in China trade on both the Chinese stock exchanges as well as over in Hong Kong. And it's notorious that the Chinese listed stocks in China on the Chinese exchanges are subject to a lot of retail buying and selling, a lot of speculation, if not even outright manipulation. And as a consequence, I think the emerging markets index operated by the MSCI franchise is wanting to be very careful that when they do include them, and it would have a gigantic representation in that index, that the right regulations are in place such that when investors around the world are looking to purchase that emerging market basket, that it is going to be fraught with something that would be untoward relative to the outcome investors think that they might experience in the returns generated by the emerging market index.
And what does this say about the markets in China? I mean, should investors be worried? Like you mentioned, a lot of the companies are traded in Hong Kong.
Well, we're a little concerned about the parabolic move we've seen in the A-share market. Now, the H shares, which are Chinese domiciled companies traded and listed in Hong Kong, actually are selling at about a 25% discount to their A-share counterparts. And so there's much better valuation there. The issue is a lot of this has been bid up both on the stimulus operated by the People's Bank of China and as well anticipation of their inclusion in the index. So we would say be long, but be careful.
All right, well, do you see other opportunities in China? I mean, should investors who perhaps were sitting on the sidelines maybe now get in?
Well, I think what we ultimately need to see is that some of the stimulus that is being underwritten by the People's Bank of China actually start to work in the economy. And right now, there isn't clear evidence that that's occurring. I think it's likely, but I think investors, perhaps who haven't yet made a commitment to China, might want to wait to be certain that the efforts have actually gone into turning around the Chinese economy and reaccelerating its growth there before committing new capital to a market that's been bid up substantially.
All right, let's switch gears to the broader markets. Give us your summer strategy. What companies, sectors do you like?
Well, I think in the U.S. there's a couple areas that look very fertile to us. One is financials, particularly the banks, the big universal money center banks. We see tremendous valuation there that is yet to be monetized. And with the slight uptick we've had in interest rates recently, there's opportunity there for their net interest margins to expand. In addition to that, their loan portfolio is growing because domestic activity remains relatively sturdy. So that's an area we like, and there's, again, good valuation support. In addition to that, healthcare remains a tremendous growth opportunity for investors. Obviously, a huge demographic tailwind, and within the healthcare sector, we like both the traditional healthcare companies, but a biotech company that actually isn't your traditional biotech. It's Gilead, which is a very large company trading about 10 times earnings. So you have good valuations there, growth profile in a space that we like, selling at a discount to both the market and the healthcare sector.
All right, Mark Lashini, the chief investment strategist at Janney Montgomery Scott. Thanks very much for coming in.
Scott.
I'm Scott Gam, and you're watching The Street.